Great Depression, made worse by 7 policy blunders, turned recession into global catastrophe.
Uncover mistakes, impacts, and lessons for today.
Welcome to The Deep Dive, your shortcut to truly understanding complex topics. Today, we're plunging into one of history's most pivotal economic events, the Great Depression. Now, you might think you know the story, but our mission today is to unpack it. Not just as some natural downturn, but as a decade-long global catastrophe, one made dramatically worse by specific human decisions. We're going to uncover 7 distinct policy blunders. These really transformed a severe recession into, well, the most devastating economic crisis in modern history. We'll dig into the context, the impacts, which were devastating, how these mistakes could maybe have been avoided, and crucially, the profound lessons. Lessons that utterly reshape how policymakers respond to crises now, like 2008 or COVID-19. We've got a fascinating report detailing these missteps, so get ready. We're going to connect some surprising dots. Okay, let's dive in. We're talking about 1929 to 1939, U.S. real output. It plummeted nearly 30%. Unemployment skyrocketed towards, what, almost 25%?
Right, a staggering figure.
And what's truly striking here, what gets me, is how the initial government and central bank actions didn't just fail to help. They actively kind of threw gasoline on the fire. So where do we start? What was the very first domino, the first blunder?
Well, the first big misstep really starts back in 28-29. It was the Federal Reserve's tight monetary policy. The Fed sharply raised interest rates, tightened credit. And what's fascinating, the context here is why they did it. It wasn't to fight inflation. Inflation was actually quite low.
Right.
Instead, it was a deliberate attempt, to prick the booming stock market bubble. Officials, especially after Benjamin Strong, the influential New York Fed governor, died, they really aimed to take away the punch bowl from Wall Street speculation. They tried to distinguish between productive credit and speculative credit.
Okay, so they were targeting Wall Street speculation, but what did that actually do to the rest of the economy, the immediate fallout?
It was immediate and devastating. This policy, it actually slowed overall economic activity. It tipped the U.S. economy into recession in August 1929.
August. So that's before the famous October crash.
Exactly, before the crash even happened.
Yeah.
It shattered confidence. People stopped spending. It basically laid the groundwork for the whole depression. Friedman and Schwartz, in their famous book, they called it the Fed's first grave mistake.
That's just astonishing. Sabotaging the economy before the market crash. I mean, that sounds incredibly risky even then. What was the lesson learned there? What did policymakers really take away from that?
Precisely. The huge takeaway for future central banks was clear. Aggressively trying to prick asset bubbles with broad rate hikes. That can backfire disastrously if the wider economy isn't actually overheating. Modern policymakers, now they prefer what they call macroprudential tools.
Well, like what?
Things like changing margin requirements for stocks or bank capital buffers, tools to target a specific bubble, while keeping overall monetary policy focused on the big picture stability. Think about 2008. What did the Fed do? Slashed rates to near zero, pumped in massive liquidity, the complete opposite of 1929. And that was driven by this lesson. Preventing deflationary collapse is job number 1.
Okay. And speaking of disastrous policies, ones that just made everything worse, the next blunder takes us from money to trade. The infamous Smoot-Hawley tariff of 1930.
Ah, yes, Smoot-Hawley.
In June 1930, the U.S. just dramatically raised import tariffs, record levels. Duties on over 20,000 goods hiked to an average of, what, nearly 60%?
Yeah, 59%. It actually started, believe it or not, as a campaign promise.
Yeah.
Just to help struggling farmers.
Okay.
But then through this congressional process called log rolling, basically politicians trading votes, I'll support your tariff if you support mine, it just ballooned. It became this massive general tariff increase. And President Hoover signed it. Even though over 1,000 economists warned against it, trading partners were screaming about it, the timing, given the global situation, was just awful.
And the reaction from the rest of the world was predictable.
Oh, yeah. Swift and brutal. The immediate effect. A global tit-for-tat trade war. Over 60 countries retaliated almost instantly. World trade just collapsed. By 32-33, it was roughly 1/3 of its 1929 level.
A third.
Yeah. U.S. exports plummeted by about 40% in 2 years. And the irony, it devastated the very farmers it was supposed to help. It just deepened the global slump, poisoned international relations. It was a disaster.
So how did that specific mistake change things long term? I mean, it sounds like the textbook example of what not to do in a crisis.
It really is. That debacle just seared a lesson into policymakers. Do not resort to protectionism in a downturn. It makes the collapse worse for everyone. Fast forward to the 2008-2009 crisis. What did the G20 nations do? They explicitly vowed not to raise trade barriers, and largely they stuck to it.
And trade recovered much faster then.
Much faster. A huge contrast to the 1930s. And, if we connect these first two blunders, you start seeing this theme emerge, this inflexible adherence to what seems like sound principles at the time, even when the world was, burning down.
All right, like sticking to the rules no matter the cost.
Exactly. Which brings us perfectly to blunder number 3, stubbornly sticking to the gold standard. Many countries, the U.S. included, just clung to this fixed exchange rate system. Currencies pegged to gold, even under intense economic pressure. And what did that mean? It meant central banks had to raise interest rates, contract the money supply right in the middle of a downturn just to defend the gold peg. The Fed did this again, notably hiking rates in 1931.
It seems baffling now, sticking to gold while economies were just imploding. What was the thinking? Why such dogmatic commitment?
Yeah, it's tough to grasp today, but the context is key. The gold standard, it acted like a transmission bell for panic and deflation across borders. So when the UK left gold in September 1931, it sparked fears about the US dollar. But the authorities here felt absolutely bound by that official $20.67 per ounce gold price.
They thought leaving gold would cause chaos.
They genuinely feared depreciation would cause chaos, yes. But in reality, their rigid commitment to hard money in a collapsing world, that proved disastrous.
So their fear of chaos actually created more chaos by forcing the completely wrong policy.
That's exactly right. Insisting on that gold parity forced central banks to tighten money, the exact opposite of what was needed. It made banking panics worse, deepened deflation. And you can see it in the data. Countries that clung to gold longer, like France, Belgium, they had deeper, longer depressions.
And those that left earlier.
Countries like Britain, Scandinavia, Japan, they ditched gold in 31. They recovered much sooner because they could finally expand their money supply. FDR finally suspended U.S. gold convertibility in March 33. That allowed for monetary expansion, and it really helped kickstart the revival.
So the lesson from the gold standard mess.
It fundamentally taught the world the value of monetary flexibility and the crucial role of the central bank as a lender of last resort. Modern central banks look at the Fed in 2008, 2009, 2020, they cut rates to zero, used QE, things totally impossible under rigid gold standard. They weren't handcuffed. Even the Eurozone debt crisis later on showed similar dangers, right? When countries lack that independent monetary control, the lesson is powerful. You need flexibility. And our fourth blunder fits this theme of rigidity perfectly too. Fiscal austerity, tax increases, right when the economy was tanking, between 1930 and 32.
Right, so revenues are falling because the economy is shrinking.
Exactly. And what did the Hoover administration do? They increased taxes and cut spending to balance the budget. The Revenue Act of 1932 was the big one, the largest peacetime tax hike in U.S. history. It tripled the top income tax rate from 25% to 63%.
Wow. Again, raising taxes in a depression, that sounds completely backward to us now. What was the rationale?
It was the prevailing wisdom then, a deeply entrenched belief in balanced budgets. Hoover genuinely thought balancing the budget was key to restoring business confidence.
Confidence through austerity.
That was the idea. There was no real precedent for large peacetime deficits. Classical economics warned against government borrowing, so even with revenues collapsing, the pressure to balance the books was immense. It led them to tighten fiscal policy at the absolute worst moment.
And the impact of hitting the brakes fiscally like that.
It's just deepened the contraction. It further reduced aggregate demand. Those 1932 tax hikes, they kicked in just as the economy hit rock bottom. It just exacerbated the collapse.
So consumer spending, investment.
Crushed further. 1932 ended up being the worst year of the Depression. U.S. real GDP fell about 13%. Unemployment kept climbing towards that 25% mark. The confidence boost from balancing the budget never happened.
So the lesson there seems pretty clear, too.
Absolutely. Fiscal policy needs to be countercyclical. In a crisis, governments are now expected to increase spending or cut taxes or both to support demand. Look at 2009, the U.S. passed an $800 plus billion stimulus package, a total reversal from Hoover's tax hike.
Right, and COVID-19.
Right. Even bigger, multi-trillion-dollar deficits globally. Direct payments to people led to a much faster rebound, despite the shock. The key takeaway, fix the debt after the recovery, not during the free fall.
Okay, this is where it gets really interesting for me, because now we're moving from actions that were misguided, maybe based on bad theory, to outright failures of intervention. Failures often driven by a kind of dangerous philosophy. Blunder number 5, The catastrophic failure to stop the waves of bank collapses.
Yes, this is devastating.
From 1930 to 1933, nearly half of America's banks just disappeared?
Roughly half, yeah. Thousands of them failed. And there was no federal deposit insurance back then.
Nothing like the FDIC we have now.
Nothing. And the Federal Reserve didn't step up adequately as a lender of last resort. It just let them fail.
Why? What was going on there? Why let the financial system just crumble?
Well, the U.S. banking system itself was very fragmented. Lots of small, vulnerable banks. But there was also this prevailing belief, the liquidationist view, famously pushed by Treasury Secretary Andrew Mellon. He saw periodic purges of weak banks as healthy, a necessary cleansing, ignoring the huge systemic risk.
Cleansing the system by letting it collapse.
That was the mindset for some. Plus, the Fed itself was decentralized, hesitant. They kind of misunderstood the situation. They saw low interest rates and thought money was easy.
But it wasn't easy if banks weren't lending, right?
Exactly. With banks failing left and right, credit was paralyzed. So monetary conditions were actually incredibly tight, regardless of the official interest rate.
And the short-term effects of letting half the banks fail? I mean, how does an economy even function?
It was catastrophic. As banks fell, the money supply itself shrank dramatically, like a 30% contraction between 29 and 33.
30% less money circulating.
Yes. Credit. Frozen. Millions lost their life savings overnight. Financial intermediation, the process of getting money from savers to borrowers, just stopped. It accelerated deflation, unemployment, confidence, utterly shattered. This was a huge unforced error. Made everything much deeper, much longer.
So what did modern policymakers learn from that, from letting the financial heart just stop beating?
The lesson was burned in. Protect the banking system at all costs during a crisis.
Yeah.
You cannot let it collapse. Think about 2008 again. Lehman Brothers was allowed to fail.
And chaos followed.
Total chaos.
Yeah.
So authorities immediately reversed course. They rescued AIG, used TARP funds, boosted FDIC guarantees, explicitly saying they wouldn't repeat the 1930s banking collapse.
Right.
Deposit insurance is now standard worldwide. The key lesson, financial panic has to be stopped. Swiftly. Decisively.
And this leads us straight into blunder number 6, which wasn't a specific policy, but more the philosophy behind the inaction, that liquidationist approach you mentioned.
Exactly. This powerful faction genuinely embraced a hands-off idea, believing government shouldn't intervene. Just let the liquidation process run its course. Purge the bad investments, the bad debts.
Mellon's infamous quote comes to mind.
Right. Andrew Mellon, the Treasury Secretary, famously advised Hoover, liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate. It will purge the rottenness out of the system. That mindset led to profound policy passivity in the early years.
Where did that idea come from, just letting it all burn down?
It had roots in classical economics, yes, but also, frankly, a kind of moral puritanism, a feeling that the excesses of the 1920s needed a painful cleansing.
Right.
It fit with laissez-faire ideas, fears of moral hazard, bailing people out would just encourage bad behavior later.
Yeah.
And the federal government just had a much more limited role back then. They genuinely hoped the market would just self-correct quickly if left alone.
I hope that proved disastrously wrong.
Utterly false. Tragically so.
So what was the real world cost, the human cost of that do-nothing approach?
The economy was just allowed to freefall from 29 to 32. No brakes applied. Businesses, banks failed unchecked. Unemployment soared. Every negative outcome was magnified by this passivity. The human suffering was immense. Widespread hardship, hunger, social unrest. And it was made worse by the feeling that the government was just standing by heartlessly. This inaction let the downward spiral just keep reinforcing itself.
Or the lesson from that?
It's fundamental. Active policy response is absolutely crucial in a severe downturn. Doing nothing is not a responsible option. It's an abdication. And modern leaders have really taken that to heart. 2008, COVID-19, governments and central banks took extraordinary, unprecedented actions precisely because they wanted to avoid another Great Depression.
Bernanke's famous line.
Exactly. Fed Chair Ben Bernanke, who's a leading scholar of the Depression, famously declared, "We're not going to make those mistakes again." That liquidationist thinking is, thankfully, largely discredited now in a crisis context. Okay, but this raises a really important question. Even if you avoid those initial mistakes, what happens if you declare victory too soon? If you think the crisis is over, but it isn't.
Pulling back support too early.
Precisely. Which brings us to our 7th and final blunder, the premature tightening in 1937. This triggered what's often called the Roosevelt Recession. By the mid-30s, the U.S. economy was recovering under the New Deal policies. Things are looking up. But then in 1937, the government and the Fed both pivoted. They started tightening policy too quickly, and it triggered a sharp relapse.
Okay, so what did that tightening actually involve, and why did they do it then if things were starting to recover?
It was kind of a perfect storm and mostly uncoordinated. The Fed doubled banks' reserve requirements.
Which meant banks had to hold more cash, lend less.
Right. Reduced lending capacity. At the same time, the Treasury started sterilizing gold inflows, basically stopping incoming gold from expanding the money supply, which it normally would have. And then on the fiscal side, FDR's administration cut federal spending, trying to move towards a balanced budget. Plus, the new Social Security payroll tax kicked in, taking money out of workers' pockets.
So monetary tightening and fiscal tightening happening together.
Exactly. Why? Well, there were growing concerns about the deficits run up during the New Deal and fears of inflation down the road. Policymakers, it seems, mistakenly thought the Depression was basically over. Time to get back to normal policy.
They were trying to be responsible fiscally, but they ended up choking off a recovery that was still fragile. What happened?
The impact was immediate and severe. A sudden, sharp economic downturn hit in mid-1937. Industrial production plummeted by a third.
A third!
Real GDP contracted about 10%. Unemployment, which had fallen to around 14%, shot back up to about 19% by 1938. The recovery just stalled, then reversed. It became a recession within the Depression.
So it actually extended the Depression's timeline.
Significantly. It was a clear, painful demonstration. Even when an economy seems to be mending, if you pull away the support too early, you can cause a really dangerous relapse.
Another hard lesson learned then.
Definitely. The Roosevelt Recession is a powerful cautionary tale. Don't snatch away support prematurely just because you see the first green shoots of recovery. After the 2008 crisis, think about how long the Fed kept interest rates near zero for years. And they raised them very, very gradually, explicitly saying they were mindful of not repeating 1937.
Right, they kept their foot on the gas longer.
They did. And the COVID-19 response also showed policymakers consciously erring on the side of maybe doing too much rather than too little. Tolerating higher inflation for a while seemed better than risking killing the recovery by tightening too soon. The overriding lesson seems to be, first, get the economy back to full health. Then you can worry about deficits and inflation. Get the patient stable before you start the rehab.
So wrapping this all up, what does it mean for us today? I mean, the Great Depression is just this sobering catalog of policy mistakes, isn't it? Lessons written in the hardship of millions.
It truly is.
It shows how decisions, sometimes seemingly small or driven by ideology, can turn what might have been a bad recession into a decade-long global catastrophe.
Yeah, and what's really fascinating, I think, is seeing how modern central bankers, modern governments, armed with this hard-won knowledge, have largely avoided repeating these specific errors. You look at the responses in 2008 and 2020. They weren't perfect, obviously, but they were dramatically different, marked by more flexibility, more boldness, more international cooperation, precisely because of the memory of the 1930s.
So policy really can make the difference between a short, sharp shock and a prolonged depression.
Absolutely. Economic shocks will always happen. Pandemics, financial crises, wars. But wise policy, informed by history, can drastically change the outcome.
The Great Depression's legacy, then, is this clear mandate. Learn from the past. Learn from mistakes. But here's a final thought for you, our listener. Beyond economics, what other historical blunders are we still learning from today? How might past mistakes be shaping our decisions right now in public health, maybe, or social policy in ways we don't even fully realize? Something to mull over until our next deep dive.